this video we're going to be looking at how the budget can be used to try and increase our share of world income, or essentially what that means is try and increase opportunities for our exporters. Increasing our share of world income is about Australia being able to become more competitive and penetrate world markets. So any policy that's going to make us more competitive, especially in the long term, is likely to improve external stability. That includes world trade negotiations, so establishing free trade agreements with other countries, whether it's with one other country, which is bilateral, or a range of other countries, which is multilateral. Support for local industries, so they may provide some form of subsidies for local industries, although they are hesitant to do this because it often leads to retaliation and other countries protecting their industries. Infrastructure spending will help in the long term because it's all about boosting our productivity and boosting demand for Australian exports. And funding for Austrade. Austrade is an organisation that's basically responsible for trying to find opportunities for Australian exporters. So the more funding that we give for Austrade, that can involve being able to seek out new export opportunities for Australia. There might be funding for marketing and advertising, so they can advertise Australian industries on a more prevalent basis, or more regular basis. Increasing our share of world income is all about trying to boost export sales and reduce import sales so that we can reduce pressure on the current account deficit and reduce net foreign debt. Try and refer to the sub-accounts whenever you're talking about a policy affecting our share of world income. Right, here are some examples of things that will either boost national savings or help to boost our share of world income. So the first one, increased incentives to invest in superannuation, about trying to save money for the future and increase national savings. Tax concessions on savings, again, trying to to encourage people to save money because they're going to pay less tax or less interest on their less tax on the interest on their savings. Again, trying to increase our national savings. Favourable taxation arrangements for exporters, any export development grants or funding for Austrade. These are all about trying to make our exports more competitive and therefore boost export revenue. Other things that will boost export revenue and our share of world income, any supply side measure that's going to reduce production costs. So whether that be microeconomic reforms like labour market reforms to make us more productive, infrastructure spending to reduce travel costs, transport costs, and increase our productivity, and that can be machinery and things like that as well. And lower company taxes are the other one. So lower company taxes will help to encourage investment spending in the short term, which could hurt our current account in the short term, but in the long term they're going to lead to more investment, more productivity, and make it easier for our exports to penetrate world markets. So all of these things will help to increase our share of world income in the future, these last four policies. Just a little bit of a recap. Explain how budgetary policy supply-side initiatives can assist with the achievement of external stability. So budgetary supply-side initiatives are things like tax concessions for research and development, spending on skill development. Again, it's all based on trying to boost productivity and efficiency, to raise our productive capacity and boost our international competitiveness. And then when we improve our productivity, that should result in lower cost of production and reduced prices, which helps to increase demand for our exports and reduced import demand, or basically lowers the prices of exports and import competing producers and makes us more internationally competitive and results in an increase in export sales. And then you want to link it to the balance of merchandise trade and reducing pressure on the CAD and therefore reducing the pressure to fund the CAD through net foreign debt or from borrowing. All right, 2016-17, this is the main policy that you need to use related to external stability. It's a $1.2 billion proposal to develop Northern Australia. And within that policy, it includes $100 million on what we call a beef roads program, which is about trying to make it easier for farmers to get their cattle to markets. Essentially what they're doing is they're using computer-based logistics or a computer program to try and assist the government to identify key areas or priorities that are going to help our economy to become more productive. So what they're going to do is they're going to use this technology to work out areas that need to develop. They're also going to invite stakeholders within the industry to try and put forward their proposals for what they think need developing, what types of infrastructure should be prioritised. Projects will be assessed based on their ability to improve productivity and help to reduce freight costs for the industry. Some of the things they're going to be doing, for example, sealing unsealed roads, so upgrading roads, upgrading bridges and key intersections according to what's the most important based on this transit analysis. Look, the actual details here is for getting quite specific, but basically they're going to be including regional roads across Queensland, Northern Territory and Western Australia. It includes new bridges, sealing or widening roads, all about trying to boost our productivity. It's also going to help the road safety of industries as well. So that's basically the key things within the policy. Talking about some of the specifics, it's $100 million. It's about getting beef to market. It's about upgrading bridges, sealing roads, making us more productive. It involves people putting in their proposals for the future. The idea of these roads, though, and you've got to be able to link it back to external stability. So it's going to reduce transportation costs, helping to boost productivity. It's going to boost export sales, which will reduce the balance of merchandise trade deficit, and therefore lower the current account deficit, which will reduce pressure on net foreign debt as the government doesn't need to borrow as much. So they're all links you need to be able to make to external stability. You could also say increased export sales should appreciate the dollar, but not as important. The other thing you could link is that the increased company profits associated with this infrastructure and lower cost of production can help to boost revenue for the government and reduce the government portion of net foreign debt, which again will lead to less interest payments in the current account deficit through government interest payments on their bonds. So that's the kind of links you need to be able to make within your answer, linking it back to external stability. I'm not going to go through the 2015-2016 policy